Hi everyone, welcome. Are we in a market crash or is this just a temporary dip? Today we're diving into real market data, breaking down sectors that are screaming value, and quite frankly exploring why the gold standard might have had it right. Plus, I'm going to share with you stocks that I am certain will thrive in this uncertain market environment. Now, before I begin, if you haven't hit the subscribe button, please consider doing so. I put a lot of work into my videos, which obviously that doesn't mean anything if you don't like the videos, but if you do, please hit the subscribe button. If you go by social media only as your indicator of whether we are in a stock market crash or not, you are definitely going to see nothing but doom and gloom. But I've been through real market crashes before. I've actually been through really severe market crashes, 2020 being the most recent one. When the market crash of 2020 began, we didn't know that it would recover so fast, right? You don't have a magic ball. You didn't know that. All we knew is that the crash was very fast and portfolios were going down like 80%. It was insane, right? What would you do? Put yourself in that situation if you weren't, if you didn't go through it. And we're not talking about a $1,000 portfolio. We're talking about a portfolio of well over $300,000, and you see it go down so much.
Take a look at the S&P 500 over the last 3 years to put this drop in some kind of context. We've been talking about this is the fastest 12% loss in history.
Station in ticks. Okay. I mean, the S&P, that means the first circuit breaker
whom the bell tolls
has been triggered.
So that was definitely one hell of a time, but let's look at the current situation where we are right now. Let's start with some real market data. Kevin Gordon, a senior financial advisor over on Charles Schwab's, posted this 14 hours ago, which I think is pretty cool. Folks not feeling good about the market. Consumers' expectations for stock prices to move higher in the next year fell in February by the most since March 2020 per the Conference Board's Consumer Confidence Index. But let's just be honest, that's not, it's the data that's presented in this chart is obviously real and, it's a fact, but you can't base anything or really make any predictions or assumptions off of this because, as you can see, historically, it just goes up and down depending on the sentiment of the consumer. And the consumer doesn't really have the vast majority of the consumers aren't into the stock market. They're not following finance, full time. So sentiment can't, looking at the sentiment and trying to make a prediction off of that is, I think, kind of way off. But it does show how people feel now. How do the consumer feels? And they feel very negative about the outlook of 2025. I will also mention in this video what is the cause of the recent market downtrend. We'll get to that in a little bit. First of all, Tesla, the past 1 month, down 26%. You can look at Microsoft, down nearly 20% the past 1 month. Google, also down the past 1 month. Amazon, down the past 1 month. So if you're looking at your portfolio and you're thinking, I must have made the worst stock picks on earth, well, maybe you did. But it's also the fact that the market is down. It's been down for the past 1 month. Let's look at this interesting chart. The S&P 500 semiconductors, right? Nothing since last June. So basically, June was here of 2024. What progress did the semiconductors done since June of last year? Sideways, basically. Sure, there was some progress. Obviously, we can't, make everything doom and gloom. But at the end of the day, we're back sideways. But what is the reason why the stock market has been going down the past 1 month? Here's a very good summary, and I think it's very, very, very good. It explains things in a nutshell. I can sit here and talk fancy and give you fancy words and fancy financial talk, and maybe most of you might not even understand it. Nothing wrong with that. I understand that people have a 9-to-5 job, they have families and all that. They don't follow the financial markets to know everything, which is why I make it simple. The report showed heightened inflation expectations fueled by President Trump's rapid fire moves over trade and tariffs, resulting in the sharpest monthly decrease in confidence since August 2021.
I see this. It's so incredible. Ding, 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 ding. Boom. Okay, Shin Boom, Star Wars.
Right? You have an economy, you have regulations, you have the world intertwined together. Everything is working in a separate way. It's not working perfect. It never does. And then comes a U.S. president, whom, by the way, I'm not taking sides nor criticizing President Trump, nor saying he's worse or Biden was better. Don't take that in a political way. I'm stating the facts. President Trump comes, and I mean, seriously, in his first 30 days of being a president, this guy has been moving in like in a blitz mode, like super blitz mode. This guy came out firing all over the place. Like the whole world just started shaking, like earthquakes all over the place, because the whole rapid, aggressive, super fast tariffs, trade wars that just, I mean, it occurred within the first 30 days. Think about it. It's bound to make shockwaves that are going to be felt globally, going to be felt in the economy. It's going to bring uncertainty. Then you have the Federal Reserve saying, you know what, I don't know what's going on here with Trump's policies. He's moving very fast. We need to see what's going on. You know, we're not going to cut rates. Let's first see what's going on with all these policies and whatever else pops in the near future. So the average 12-month inflation expectations surged from 5.2% to 6% in February. Another reason why the markets are in a downtrend, I think, is overvaluation in many sectors within the U.S. Looking at the S&P 500 auto industry, this is a very interesting one. I like this one. It shows that the auto industry is now down 34.3% from its December high. So there was the December of 2024, and into 2025, the auto industry has suffered nearly 35%. And lo and behold, February 26 of 2025 arrives, and Tesla's market cap falls below $1 trillion as European sales drop. And like I said, Tesla the past 1 month is down 27%. One member in my Discord asked the following question: what's a good European EV to buy? Tesla Europe sales are declining. Good question. If you've been following this YouTube channel, you know that late 2024, I did a YouTube video for Renault, which is a French automaker. At that time, and held until today, you would be down less than 0.5%. The stock is pretty much trading at the same price as it was when I had made that YouTube video, which maybe isn't something to boast about and, you know, brag about. But when you look at the auto industry being down nearly 35%, and auto stocks suffering, this is pretty cool, right? So that's one European stock that I'm looking at. The Russell 2000 has wiped out all gains since September of 2024, and now only has 44% of its members trading above their 200-day moving averages. It sounds tragic, but it's been worse. It's been worse. I mean, there were worse times, and we got over that, and things went well. When I mentioned just a little earlier, I mentioned sectors, right? And that some sectors in the U.S. are overvalued. Let's look at the U.S. sectors. So let's understand what's going on here. The basic materials sector, you have the communication services, you have consumer discretionary, right? All of these sectors. Now here we're focused on the returns, but if we were looking at the PE ratio of a sector, most of the U.S. sectors are overvalued. The only sectors in the U.S. right now that you can look at that are not overvalued on a PE ratio basis, let's say, is the energy sector and the healthcare sector. The past 1 year, the basic materials sector has only given 2.10% positive return. Communications up 27.5%, consumer discretionary up 19%. Let's see, the financial services up 26.4%. Utilities up 28.2%, but I wouldn't look at that and say, okay, if it's up 27% the past 1 year positive return, I need to focus just on that sector. I tend to like to focus on sectors where in a year, the past 1 year, they didn't give huge returns. And I like that because there is rotation. When we're talking about rotation, smart money rotates within sectors. If a sector is overvalued, they made their money, they're out, they go to another sector. I mean, they don't get completely out. They keep some stock. You never completely get out of anything. But the energy sector, guys, is up 4.28% for the past 1 year. The healthcare sector is 0.7%. If I were to focus on something going forward with an uncertain economy, I would focus on the energy because energy is always needed. I would focus on utilities because people are going to pay their bills. or else, you know, electricity, no water, right? And then what else do people put on top of everything? Healthcare. And the healthcare sector has only given back the past 1 year 0.7%, and it's undervalued. So if you can find something within the energy, the healthcare, and the utilities, and that is a good company, good free cash flow. Look at that. Is the free cash flow good, consistent with the past 5 years? Revenue consistent for the past 5 years, and you invest in that, you're going to do well. But if you can't handle volatility, guys, if you can't handle this, something I put in the Discord yesterday, volatility isn't for everyone, and that's fine. There's nothing wrong with it. If someone can't stomach seeing a red period in the market, they should just invest in a SPY ETF and don't ever check the markets. Now, I mentioned the gold standard. The gold standard worked very well. The gold standard was a much better way of handling inflation than the dollar. Up until we had the gold standard, things were fine. Ever since we left the gold standard, things have been very volatile. We have had more market crises, more economical crises, more stock market crashes. And let me show you what I mean.
But when you're on a gold standard, there really wasn't much inflation at all because you couldn't print money. Because the whole definition of inflation is increasing the monetary supply, which our government is doing at an astonishing rate right now. When you're adding $2 or $3 trillion a year to the monetary supply, it's going to cause inflation. You don't have a choice. Back in the day, when we were on the gold standard, you just couldn't print gold, and therefore it kept inflation in check. The bankers complained about it. They wanted more money in the system, so they could loan more money, but that caused inflation. Right. Gold standard, it worked. It's worked for thousands of years, but we always have these brilliant bankers and government politicians that want to print money and get us off.
I think that was very interesting what he had to say about gold. Let me know in the comment section below what you think. Should we go back to the gold standard or stay where we are now? I mentioned that the basic materials sector has been up like 2% something for the year. Basic materials will always be needed. There's one stock that for the past 1 month hasn't suffered at all. So that's Safe Bulkers. If we look at Safe Bulkers, the past 1 month, it's up 15.38%. This same exact month where Google, Amazon, Tesla, and many other stocks are down over 20%. That's because basic materials are needed. Basic materials, Safe Bulkers is a dry bulk shipping company. They ship with their ships globally, grain, cement, iron ore, basic materials that we're all going to need and use in our economies no matter what. Talking about gold, IAG, all right, it's at 557. On January 13, 2025, I had called IAG, which is a gold stock. I called it a buy at 557. And then at 648 on February 5th, 2025, just a little bit before the market started going downwards, I called it a sell at 648. So we made money, right? Bought it at 557, sold at 648. Today, as I'm recording the video, guess what? IAG is back at 557. When we look at the median consumer inflation expectations for the year ahead, that has shot up to 4.8% in February per the conference board, and the largest 2-month jump since June of 2022. So yeah, again, let me repeat this. This is the median consumer inflation expectation. What is going on right now in this market is a concern or fear of the super fast, I would say aggressive, very fast, just moving way too fast. Like, I think that the current administration, I mean, they have 4 years that they're going to be in power. Like, do what you want to do. Can't you do it at a little bit slower pace? We need to chill a little bit. I think this is just my opinion. Take it a little slow. But in the meantime, here's stocks that I think will do well in this uncertain times. Occidental Petroleum, ticker symbol OXY, it's trading right now at $49.10. I would not bet against Warren Buffett, and it is in the energy sector, which is an undervalued sector in the U.S. If I were to look into the energy sector, which is undervalued, and look at a great company to get into, Occidental Petroleum fits, like, it's the top for me, and it's an investment. Don't get into it as a trade and be like, oh, I need to get in now, and within the next 5 days it needs to go to $100. No, just don't. It's an investment. I also like TLT. I had called that on November 27, 2024 in my Discord, $92.37. It's now trading at $91.15, and it's been going up the past 1 month relatively to the market going down. And with this uncertainty, I think more investments, more money will be poured into the iShares 20-year Treasury bond ETF. So that's bound to hit $100 this year. This is just my opinion. You know, we'll see. References to inflation and prices in general continue to rank high in write-in responses, but the focus shifted towards other topics. There was a sharp increase in the mentions of trade and tariffs, back to a level unseen since 2019. Look, let me mention something real quick, which you can take it as a joke if you want. The word tariffs sounds as tariffs in the ears of US citizens, but globally right now in other countries it sounds as punishment. Like President Trump may mention the word tariffs, the US citizen in his ear heard tariffs, but the ear of every other citizen from other countries, they hear the word punishment. Because trust me, like I say, you can take that as a joke, but it's also kind of a reality. Because countries right now are feeling that they are being threatened with some sort of punishment. And it could be a right punishment or wrong. Like, for example, President Trump said that I'm going to impose 25% tariffs on the European auto industry. And I think he's right on that, for example. Right? So here's an example where I think he is right. Because for the past decade, the European automakers have enjoyed a 2.5% tariff on their vehicles being sold in the US, right? But when American cars were trying to be sold, when American companies tried to sell their cars in Europe the past decade, they were met with 25% tariff, which was insane, right? That's not right. That's not even fair. So there are some things in the way the current administration is moving that are fair. I'm not going to get into everything because that's just a whole separate video. Some other things may be seen unfair, but basically that's it. And then behind all that is whether inflation is going to go up or not due to all of this uncertainty of these policies. That's basically it, guys. Is there going to be a market crash? Are we in the beginning of a market crash? I don't think so. This isn't a recipe for a market crash, at least not yet. So I believe that this 1 month that the markets have been going down is not a phase of, the beginning phase of a market crash that people say and all that. It's not. It's not. It is a uncertainty over inflation. And if inflation data this year progresses towards the positive side, we'll be fine. So that's basically all that it is revolving around, is policies, and basically at the core of it, inflation for the US. Let me know in the comment section below what you think. I wish you all the best, and make wise choices when you invest.